Brian, great to have you here on Capital Empower. Let's take a look ahead, 2026. Are you seeing a positive year? Because we're getting warnings just recently from people like Jamie Dimon.
Yeah, I still see a positive year on the whole of things, but there is definitely a rotation. What was driving the market over the last couple of years is not likely to be the same upward momentum. What we're finding is a broadening out. Q1 earnings so far still better than expected. We're seeing 12.5 to 13% earnings growth on the S&P 500. That generally means with a broad base of growth, we should see still a positive year in stocks overall.
And are we seeing a rotation out because there's this fear of AI and we're seeing a sell-off in tech, but then we get the kind of schizophrenic backlash and people buy up tech again? How should I position myself as an investor?
Yeah, I think AI momentum has certainly turned into AI anxiety in the moment. And there's a couple of different drivers. One of the premier ones being all of the money being spent by the hyperscalers. We're talking about $640 billion in CapEx this year alone. When does that money come back to companies like Amazon and Microsoft? And will it be profitable after having spent that much money to try and grow AI computing power? That's a big question that has yet to be answered. The other part of it is what type of AI is going to be driving the market. We've been used to the large language model side, which drives AI agents, and we've seen some pretty wide adoption even at company to company scale, the enterprise solutions that are out there. But now we're starting to see the more generative AI, which are the bots that are doing things autonomously, begin to grow. And the battle over sentiment is that the bots are going to take over the agents and you're not going to need them anymore. I'm not convinced that that's necessarily true in the moment, perhaps over time, but it is adding to that anxiety sentiment right now.
Well, I think the CEO from Anthropic actually said that entry-level workers will be replaced by AI within the white collar within the next 1 to 5 years. And then he said it's happening much faster than that. Is that the anxiety you're talking about, or is it something else?
Yeah, I think that's exactly the anxiety, is that bots are going to replace jobs and the unemployment rate could go substantially higher. There was a research paper that was released over the weekend that specifically talked about that. I think that fed into, again, some of the fears around AI taking over work from humans, and that just leads to this anxiety story. Again, there are a number of things that have to fall into place in the right way in order to make this timeline livable, if you will. 18 to 24 months for this type of scale would be a very rapid adoption rate. And to be perfectly honest, we don't have the level of computing power available in order to support that much AI adoption in the ground right now. So that the data centers that have been planned have to really ramp up and catch up so that just the availability of compute can keep up with the demand for that level of AI power, if you will.
Should I be looking at investing in energy, in companies that will generate electricity? AI data centers get a lot of criticism, but the fact is the United States really hasn't been building out its electric generating capacity for several years. We've actually been cutting back, haven't we?
Yeah, absolutely. I think that energy is a great sector. In fact, it's one of the best performing sectors year to date inside the S&P 500 for that very reason. Normally, utilities don't see this type of energy, and I mean momentum when it comes to growth, but the amount of investment that's being made just to have the available electricity to fund, both the AI data center load, but also the regular consumer activity is going to be important, and that's definitely growing. And there's multiple sources that are being used in this moment in time. The long-term view is that nuclear is the way to go. It's the most clean and efficient way to generate electricity, but it takes a long time to bring new reactors online. So in the interim, what we're seeing is ancillary businesses like natural gas produced power plants that use jet engines, basically. So the turbine business is a great place to be. So there's all of these little AI adjacent pockets in this market that's adding to that broadening effect that we're seeing over the earnings season so far.
And assets under management, 25 billion, is that correct?
Yes, sir.
So what allocation and timeline do you have if you're looking at energy?
So if we're looking at energy, again, some of the adjacent sectors, things that we like are the people that are actually going to be building out the new grid, meaning there's going to be copper that's going to be in demand. So things like 3M and Newmont Mining are going to be mining out that copper. And then American Electric Power owns the most transmission lines in the country. So there's ways that you can go about that and even sidestep some of the regulatory constraints in the utilities directly. So looking at different ways that we can really involve ourselves on the AI adjacent trade that are benefiting from that $600 billion in spending that's going on right now.
And let's talk about Jamie Dimon's warning, and it has to do with credit, private credit, and essentially corporate debt. If I'm reading a Bloomberg article correctly, the revenue being generated for corporate borrowing is actually coming from ETFs. Is there a danger for people who are investing in ETFs and might be oblivious to the warnings about private credit and corporate debt?
Well, the biggest warning from Jamie Dimon, and we happen to agree with him, is that in that private credit universe, you really don't know what you own. You own fractional shares of a bunch of stuff, but it's really pretty opaque. You don't really get down to the granular level to understand what the credit quality is of everything that you own. The concern being that you might still have some Party City paper sitting on your account that the company went bankrupt a year ago, right? So there's some concerns out there about just the lack of transparency, and the overall credit quality could be substantially different from what they're saying in terms of their mark-to-market valuation of that paper, if you will. The silver lining to this is it is held privately. It's not necessarily traded in the public market. That has allowed credit spreads to remain relatively tight, and we haven't seen a huge impact. The problem would be a domino effect, where if we saw something come out, along the lines that we saw in the automotive sector about 6 months ago, where there could be some bad paper out there that does create a wave of fear in the private credit market, and then we see the disruption and valuations follow after that.
Correct me if I get this wrong, but having covered the great financial crisis and the collapse, and I can think back to when those two Bear Stearns funds, went belly up in the summer before all of that. Let's talk about the exposure and contagion. If you don't know where it's being held, the bond funds could be holding it, and potentially ETFs that are trading bond funds. Wouldn't that be the danger?
Yeah, that's absolutely the danger. And the concern would be also in some of those pension plans and things of that nature that are relatively difficult to move tactically as it is. So yes, that would be the fear of contagion. Now, I think overall, our view of the credit quality is still that it's pretty decent, but there are a rise in public bankruptcies. We had almost 1,000 large public bankruptcies last year. That's double the normal average. So there is stress underneath the surface of this economy. And so really does come down to being a little bit more active in your portfolio allocations, know what you own, know why you own it kind of a scenario.
And for a lot of people who invest via their 401ks and might even just do an index fund, do you have a prediction for where we might see the S&P at the end of this year, up, down, whatever?
Yeah, a mild up year. Again, we do see a broadening sector by sector. Earnings growth is still positive, but not every single company is going to be a winner. So our view of the S&P 500, if earnings are going to grow by 10%, maybe we get a 7, 8, 9% up year on the S&P. That gets us in the low 7,000, 7,300, 7,350, something along those lines. I do see, and obviously it's already played out, that more volatility is going to be on the spectrum. If you think about it, over the last 3 years, the S&P is up over 80% in that period of time. There's been volatility. It's just been all to the upside, right? The average intra-year drawdown is between 18 and 20% over the last 75 years. That's more likely to be back in play in a year like this as we start to see leadership change, which type of AI is going to win, and will it really be able to scale up and take jobs away in the worst case scenario, if you will, from the doom and gloom type of people. So lots of questions to be answered. That means there's uncertainty. Uncertainty means volatility.